Welcome to mortgage calculation case number 2 with Robert Klein. So what we're going to do now is we're going to determine how banks will actually look at rental incomes. And now this subject is going to be actually quite detailed and a bit complicated, but if you are purchasing other properties or you do have other properties and you want to refinance it, this video is pretty important.
All right, banks look at rental income two different ways. First is something called an offset, a rental offset, and the second one is called a gross up. And both these are dramatically different. So let's assume a property has a rental income of $2,000 a month. The top of the line rental offset programs for the general top of the line will allow you to offset or use 80% of this income, or $1,600 a month. From this $1,600 a month, they'll allow you to deduct your expenses directly from it. So I just did a quick calculation on a mortgage. I think it was about 300 grand. That payment would be $1,230 a month, minus now the tax of $100 a month, minus your strata, $130 a month. So what you're left with is this net amount of 1,600 minus 1,230 minus 100 minus 130 will leave us with a positive $140 a month. So this property pretty much funds itself, and the bank won't require any more of your additional income to supplement it. So in theory, if you had a job that paid you $0 a year, you'd be able to afford this house because of this offset. Gross up, I'm not going to go into specifically how it's set up. It gets a little bit confusing, but on average, if you compare it to an offset, it's going to be equivalent to a 20% offset. So that means if you had an income of $2,000 a month, they're only going to allow you 20% of this income to be used, or $400 a month. We then pay off our mortgage of $1,230, pay our taxes of $100, pay strata $130, and we're now left with a negative amount of $1,060 a month. So the bank wants to know where that $1,060 is coming from. Well, in this scenario, it would have to come from your income. So what we're going to do is to calculate 1,060 times by 12 is $12,720. Now, the bank is not going to allow you just to say, okay, an extra $12,000 fine. Remember, they're only going to assume you have perfect credit. I don't want to go into specific details or confuse you, but remember that term total debt service ratio. They actually will only allow you to use 44% of your income to do that. Therefore, this calculation is going to give you the actual income amount that you're going to have to subsidize this property by. So from your job, they're going to require $29,000 of income to subsidize this rental, on top of your personal, other principal residences, on top of your other rental properties, etc. So the gross up versus the offset, this is dramatically different. The people that you know that own 5 or 6 or 7 houses, I guarantee you, are forced to use this. The ones that are not familiar how to do this and they think you can only have 1 or 2 maximum have probably only been shown this. So this is how the banks look at rental incomes.
So obviously rental offsets are a lot better than the gross up. There are a few banks that really specialize in the offsets, and pretty much that's where all the rental business goes.